This is Andrew Stotz of A Stotz Investment Research to talk about my latest academic style research entitled Analyst EPS Forecast Accuracy. Remember our academic style research format. We start with a question, we review prior literature, develop a hypothesis, select and clean data, set up our methodology, review the results, and advise how to apply to improve investment decisions. So let's start off by studying the behavior of financial analysts. The question I have is, are financial analysts' earnings forecasts accurate? Well, let's talk about the review. I've intensively reviewed 45 papers that found that analysts are optimistically inaccurate. Analysts were generally inaccurate and optimistic. Prior research calculated this inaccuracy. They also tried to identify whether error had a pattern to it and considered both individual analyst performance as well as consensus earnings forecasts. There's 7 issues from prior research that I see. Issue number 1 is that most research scaled error by price, not earnings. What do I mean by this? Well, look at this formula right here. You can see forecast earnings minus actual earnings divided by share price. That gives what I call scaled forecast error. But that's the way most places did it. And the problem with this for most prior research is that it's hard for it to be comparable because that share price could be wildly swinging over time or from stock to stock. So therefore, what I do is scale the error, which is the difference between the forecast and the actual, by the actual earnings. The second issue that I see is a shifting definition of a forecast time horizon. So basically, if we look at an analyst that was 20% in error, analyst number 1, 12 months prior to when results came out, and analyst number 4, who was 20% in error 1 month before results came out, are they equally accurate? No, they're not, because analyst number 4 had 11 months of information and data. So we're not really comparing apples to apples. So we must make sure that we're always comparing apples to apples. Now, the next issue I saw was execution time frame. Many of these can be unrealistic for fund managers and investors to actually execute, because in prior research they may say that an analyst or a fund manager will execute based upon an analyst changing a recommendation. But the truth is that a fund manager can't just switch in and out of stocks just because an analyst said so. They have their own process of due diligence. Another one is that the research is overly focused on explaining individual analyst forecasts, but really investors don't have time to keep track of which analyst is outperforming versus which one that's not. And also, the research has shown that analysts have been better as reporters, not originators. In fact, some great research has recently shown that analysts are just piggybacking on the prior news that has come out from the company and adjusting their earnings from that. So the news was actually the originator of the information. The analyst just adjusted to it. And then also what I would call underutilized research. There's actually some research that shows that people don't use research. So therefore, even though there may be a knowledge of where there's an opportunity, people aren't reading it and aren't taking advantage of that. And then you've got the cost-benefit analysis, because analysts are paid a pretty penny to do their job, and it's not often that can be offset by the benefit that can be derived over a long period of time. So now let's move on to the hypothesis. Hypothesis is financial analysts are optimistically wrong. Number 2, they were more wrong in emerging markets. Let's talk about the data. Basically, according to World Bank, there's 109 stock markets in the world, 47,000 listed companies, and a market capitalization of $52 trillion. In this research, we used monthly data on stock exchange listed companies across the globe that were trading in the stock market at any point during the 12-year period from January 2003 until December 2014. We used consensus estimates rather than each individual analyst's estimates, and these were sourced from Thomson Reuters iBest estimates, which contains about 45,000 companies across 70 markets. Let's talk about the method and some of the standard definitions for a moment. First is the definition of forecast error. That's just the difference between the forecast earnings and the actual earnings that eventually happen. So FE, forecast error, equals F minus A, forecast minus actual. Now we can scale that and we call it scaled forecast error, which is just the FE or forecast error relative to something such as share price or actual earnings. So scaled forecast error equals the forecast error divided by the absolute value of actual earnings times 100. Again, I use actual earnings, not share price, in scaling the forecast error. Remember that the absolute value in the denominator assures that the correct calculation emerges in cases of A, or actual, being a negative value. The other standard definition here is absolute forecast error, which is the absolute value of the difference between forecast and actual earnings. So there you have the difference between forecast and actual, and then we take the absolute value of it. This eliminates the issue of whether an analyst was optimistic or pessimistic. Scaled absolute forecast error is absolute forecast error relative to something such as share price or actual earnings. And yes, you've got it right. I look at scaled absolute forecast error relative to actual earnings. So now let's talk about a 6-step process to prepare the data. I spent a lot of time trying to figure this out, and I'm going to walk you through how I did it. First, I created the starting data set. First, you have to select the minimum size of companies, otherwise you have too much data. Second, you must have at least one EPS forecast, or else you're not estimating forecasts. And I require that you have to have one target price and recommendation at least, because I want it to be a full forecast, comprehensive coverage. Now, once we've done that, we've got a short list. Now you apply some filters to this starting data set. The first we want to do is remove tiny numbers that produce an extreme scaled absolute forecast error. So very tiny numbers can produce 10,000% in change when in fact it's almost meaningless. The next thing we have to do is think about how we should truncate extreme scaled absolute forecast error, meaning cut off the extreme positive and negative numbers. And finally, we need to select the minimum number of analysts. Right now, I've said that there has to have at least one EPS forecast, but maybe if we were looking at the average of analysts, then maybe we couldn't have one. We'd have to at least have two. So if we go through that process, I won't bore you with the details. I'll just show you my selection. So first of all, for minimum size, we started with greater than or equal to $50 million market cap. Next, we must have at least one EPS forecast and, as I said, at least one target price and at least one recommendation. Next, I removed tiny numbers that produced an extreme scaled absolute forecast error, and the point that I selected was any tiny numbers that are less than or equal to 0.04 that also produced a scaled absolute forecast error greater than 200%. So if it did not produce a significant error greater than 200%, then I left that small tiny number in. Then I truncated the scaled absolute forecast error, which basically means I removed outliers that were plus or minus 500%. So if an analyst was 10,000% wrong, I removed that point because it would skew the data and it would be meaningless. Finally, I selected a minimum number of analysts, and in my case, I selected at least, actually, this is an error, I actually selected greater than or equal to 3 EPS forecasts. So what did I end up with? In the 2014 numbers of my data set, you can see that the total companies were 7,434, and 66.9% of them came from developed markets. Let's move on to the method. We calculated the scaled forecast error, which is the forecast error relative to something. In this case, we're going to use actual earnings. And we did this for every stock for every year. And then we took an average for each year. And here is the results of what we found. Analysts were 25% optimistically wrong over this 12-year period. Best years were only wrong by 10%. Worst year, 2008, when earnings collapsed, they were wrong by 55%. Actually, that's interesting right there. That point Basically, analysts probably didn't move much. Instead, what happened was earnings collapsed. And you can see also that the bottom of this chart is at 0. So it goes from 0 to 10 to 20 to 30 to 40 to 50 to 60%. Analysts were never pessimistically wrong. Now let's look at emerging markets, and we found that their error was 35%. So emerging markets analysts have been much more optimistically wrong, especially from the period 2010 to 2014. So what is the action we can derive from this? Maybe adjust analysts' earnings forecast down by 20 to 30% to arrive at your own more accurate forecast. And the second is to adjust down further earnings forecasts of analysts in emerging markets. So that wraps it up. Come to the website, become a better investor now. Know it first. Get your information. Get access to additional research and articles, and get your free membership and newsletter. Just go to babinow.com/join. Have a great day.